Welcome back to the Neuro Finance Masterclass, and welcome to Day 71 of our 365 Days to Financial Freedom series. I am absolutely thrilled to have you here for another explainer today, because we are tackling something incredibly vital. Today's theme is crypto diversification and the altcoin trap. You know, if yesterday was all about buying the broad haystack with traditional ETFs, today we're stepping into a completely different arena. We are bringing disciplined, cold, hard logic straight into the Wild West of cryptocurrency. Listen, if you've ever felt like your crypto portfolio is just this wild roller coaster that you have zero control over, this explainer is going to completely change how you operate. We're shifting from being passive participants to becoming what we call the crypto architect.
So, I've got to ask, are you married to your crypto? I know, it sounds kind of absurd in a financial context, right? But I want you to be brutally honest with yourself here. This is hands down the single biggest mistake retail investors make in this space. It's wild, but it always starts the exact same way. You find a small, obscure project, read a really compelling white paper, join their Telegram group or Discord server, start chatting it up with the community, and literally before you know it, you've made this coin your entire identity. You aren't just holding a financial asset anymore. You're out there defending a belief system. But here's the hard truth. In Neuro Finance, we have no friends in the market. We only have assets. That is our golden rule, and truly understanding it is the absolute key to breaking this emotional trap. Look, when you marry a coin, you totally lose your objectivity. The market shifts, the coin drops 20%, then 50%, and eventually, it's down 90%. But the retail investor doesn't sell. Why? Because they're emotionally attached. They feel like selling is somehow a betrayal to their online community or some admission of personal defeat. But let me tell you, the market does not care about your loyalty. The market only cares about mathematics and capital flow.
Let's get into Part 1, the altcoin graveyard. To actually break free from this emotional trap, you've got to understand the sheer, brutal scale of destruction this number represents, 99%. You absolutely have to understand this math if you are going to survive in crypto. In every single crypto cycle, thousands of new coins emerge, right? They build up massive hype, they reach staggering all-time highs, and then, boom, they plummet 99%. And here's the real kicker. The vast majority of them never, ever return to those highs. They just die in the altcoin graveyard. If you're sitting there holding onto a bag that's down 99%, just praying for a miracle because your Telegram group says we're going to the moon, you are flat out ignoring the mathematical reality of this space.
This brings us to a major crossroads. On one hand, we have the gambler. This is the person who takes 100% of their money and just dumps it into one single moonshot project. Let's be crystal clear about this. If you do this, you're not an investor. You are a gambler sitting at a broken roulette table. It's completely emotional. But then, on the flip side, we have the architect. The architect recognizes that while Bitcoin might be the undeniable king and the foundation, altcoins are essentially just high-risk experiments. The architect operates on a strict, risk-weighted, math-driven strategy. They don't have an emotional connection to a coin, they only care about risk-adjusted returns. They're building a fortress with a foundation of stone, not a flimsy house of cards. Which leads us perfectly into Part 2, the 70-20-10 portfolio role.
So how exactly does an architect build that stone foundation? How do the pros structure a resilient crypto portfolio that actually survives the graveyard? Well, they use this exact risk-weighted structure. Notice the visual imbalance here? It's striking, isn't it? And it's 100% intentional. That massive 70% block is entirely dedicated to your foundation. It is heavily protected. Then you've got a moderate 20% slice, and only a tiny, tiny sliver, just 10%, is allocated for those high-risk bets. This imbalance is literally your armor. It ensures that even if your speculative bets go straight to zero, which remembering the graveyard they often do, your overall portfolio remains structurally sound and your financial well-being is completely intact.
Okay, let's break down that massive 70% foundation. These are what we call your blue chips. In the crypto world, we're primarily talking about Bitcoin and Ethereum here. Think of these as the index funds of cryptocurrency. Why do they get the absolute lion's share of your capital? Simply because they have the deepest liquidity, the longest track records, and mathematically speaking, the absolute lowest chance of going to zero. An architect knows that without a massive, unshakable bedrock of Bitcoin and Ethereum, you don't actually have a portfolio. You just have a handful of lottery tickets. This 70%, this is what lets you sleep peacefully at night.
So, the really crucial point is how we handle that remaining 30%.
Your next 20% goes straight into mid-caps. These are established projects with real, provable utility, but they definitely come with higher volatility than your blue chips. They offer some really strong growth potential, but they do require a bit more monitoring on your end. Then we have that final 10%. This is your speculative bucket, your moonshots. Listen to me very carefully right now. This is your gambling money. The rule for this 10% is dead simple. If it goes to zero, your life does not change. You don't miss a rent payment, you certainly don't delay your retirement. But hey, if it goes up 100x, it's a phenomenal bonus. Just never, ever confuse that 10% bucket with your 70% bedrock.
Moving right along to part 3, harvesting volatility.
You see, having the right structure is only half the battle. An architect never just sets it and forgets it. Imagine this scenario for a second. Step 1. You get lucky. A coin in your 10% speculative bucket absolutely skyrockets. Incredible. But suddenly, in step 2, because of those massive gains, this highly speculative, incredibly risky coin now represents 50% of your entire net portfolio. The gambler rejoices and just holds it, thinking they're financial genius. But the architect realizes they are in extreme danger. Their risk profile is completely broken. This requires what we call neuro fitness. Step 3. You must ruthlessly sell a large portion of those gains. You do not ask the Telegram group for permission, you just sell. And step 4. You take those profits and immediately move those funds right back into your blue chips. You restore the balance.
You're essentially harvesting the volatility of the small coins to grow the strength of your foundation. Honestly, this completely reframes why we even bother with that 10% speculative bucket in the first place. The goal of buying a small moonshot isn't to hold it forever and ride it off into the sunset. No way! The true purpose of that 10% gambling money is to capture explosive, chaotic upside, pull that wealth directly out of the chaos, and use it to buy more Bitcoin and more Ethereum. You are literally feeding and reinforcing your 70% foundation using the wild, unpredictable volatility of the altcoin market.
Let's wrap this up with part 4, the architect's shield.
This disciplined process forms your ultimate shield against market crashes. And that leads directly to your cognitive task for today. I want you to do an immediate, ruthless audit of your holdings. Remember this phrase: we are not here to be right about a specific coin. We are here to be rich at the end of the year. You've got to drop your ego entirely. If you look at your portfolio today and realize you're carrying doomed projects, or maybe you are massively overexposed, like you've got 60% of your money sitting in speculative altcoins, you need to take action right now. Stop worrying about proving a point to an online community. Realign your assets strictly to the 70-20-10 rule. Cut those emotional ties, harvest your volatility, and above all, protect your capital.
Which leaves us with this final, definitive thought to chew on. The architect builds with stone, not with hype. Guys, the crypto market is quite literally designed to extract wealth from emotional gamblers who just chase green candles and marry digital tokens. But you now have the blueprint to step outside of that trap entirely. By anchoring 70% of your portfolio in blue chips and ruthlessly harvesting the volatility of your small bets, you completely transform that chaos into a calculated engine for wealth generation. So leave the Wild West behind, take control of your assets, maintain your neuro fitness, and start building your financial freedom on a foundation of solid stone. Seriously, take a hard look at your portfolio today. Because if the market crashes tomorrow, will your crypto foundation hold strong, or will it collapse straight into the graveyard? Thank you so much for joining me for this explainer, and I'll see you in the next one.